All right, let's talk about the One Big Beautiful Bill Act. It just got signed into law, and honestly, it is hands down the biggest shift in American tax law we've seen in nearly a decade. We're talking permanent tax cuts, a bumped up standard deduction, and get this, completely eliminating federal income taxes on tips and overtime for millions of workers. Plus, a massive overhaul to student loan repayment kicking off in July of 2026. The catch? Most people have absolutely no clue what's actually in this thing, let alone how to position themselves to take advantage of it. Well, that's exactly what this explainer is for. I am breaking down every major change in plain English. No politics, no spin, just the cold, hard facts about the new financial landscape and exactly what you need to do with your money. So, the million-dollar question, how does this new tax bill actually affect your money? It's so easy to just tune out financial news, right? But whether you earn tips waiting tables, write a check for student loans every month, or you're raising a family, these new rules are dictating what's in your wallet starting right now. You literally cannot afford to ignore this. Because understanding these changes isn't just about being a news junkie, it is about keeping way more of your hard-earned cash right where it belongs, in your own pocket. Okay, here's our roadmap for today. We'll start with number 1, the One Big Beautiful Bill itself. Then 2, your paycheck and deductions. Number 3, student loans and education. 4, the winners and losers. And finally, number 5, your step-by-step tax action plan. Let's dive right into Section 1, the One Big Beautiful Bill. Like I mentioned, this is the most sweeping piece of tax legislation since 2017. We are looking at massive, permanent changes across the board. The major provisions really take full effect in 2026, and man, it touches almost every single corner of your financial life. We're talking individual income taxes, the whole structure of student loans, how you handle your retirement accounts, and even the math behind your charitable giving. Now, rather than debating the politics of how this whole thing got passed, our focus today is 100% on what it means for your personal finances. Because regardless of where you stand politically, these are the new undeniable rules of the game. Moving right along to Section 2, your paycheck and deductions. Okay, the biggest foundational shift here is that the individual income tax cuts from back in 2017, which, remember, were actually set to expire after 2025, well, they've been made permanent. So your current tax bracket, it is locked in indefinitely, which basically prevents an automatic tax hike for middle-income Americans. And here's a massive number for you. $30,000. For married couples filing jointly, that is your new approximate standard deduction in 2026. If you're a single filer, you're looking at around $15,000. Because this standard deduction, which is just the amount you chop off your taxable income without having to itemize, has been bumped up and made permanent, the vast majority of us are simply going to have a lower taxable income. Bottom line, you are paying less in federal taxes without having to hoard a shoebox full of receipts. Now, for millions of hourly workers, the game has completely changed. The new bill actually eliminates federal income tax on tips for workers in eligible occupations. Think food service, hospitality, delivery drivers. But wait, it gets better. It also entirely eliminates federal income tax on overtime pay. No way, right? But it's true. If you work hourly and pick up an extra shift, that overtime cash is now federally tax-free. This is a real game changer that puts immediate money right back into the pockets of service, healthcare, and hourly workers everywhere. Now, just one quick caveat to keep in mind. While the federal income taxes are wiped out on this money, your standard payroll taxes, Social Security and Medicare, those do still apply. And for all the parents tuning in, you can absolutely breathe a sigh of relief here. The child tax credit is officially preserved right at $2,000 per qualifying child. On top of that, the bill maintains the refundable portion, which is known as the additional child tax credit. This is huge because it stops the credit from reverting back down to lower amounts. So those valuable child tax credits your family has been relying on, they're going to continue right at their current levels. All right, let's shift gears to Section 3, student loans and education. So the old income-driven repayment plans, including the SAVE plan, yeah, those are completely gone. Enter the new Repayment Assistance Plan, or RAP. Under the RAP plan, your monthly payment isn't based on discretionary income anymore. Instead, it's calculated strictly at 1 to 10% of your adjusted gross income, with a mandatory minimum payment of $10 a month for all borrowers. Plus, and this is a big deal, the forgiveness timeline is being stretched out to 30 years, which replaces those older 20 to 25-year periods. You absolutely need to sit down and run the math to see exactly how this changes your specific monthly budget. Now, If you are looking at higher education beyond a bachelor's degree, listen up because this is a monumental shift. Starting in 2026, Direct Plus loans are eliminated entirely for graduate and professional students. Gone. You won't be able to borrow Federal Plus loans to cover those extra costs beyond the standard graduate loan limits anymore. Instead, you're going to be capped at the standard and significantly lower unsubsidized direct loan limits. So if you're planning on going to med school or law school, your funding gap just got a whole lot larger. Honestly, your entire financing strategy needs to pivot starting today. Let's move on to Section 4, Winners and Losers. Looking at the beneficiary side of things, service and hourly workers are clearly huge winners here thanks to those immediate tax savings on tips and overtime we just talked about. Middle-income Americans win big by locking in those lower permanent tax brackets. Families win by keeping that $2,000 child tax credit, and small business owners win by hanging on to their 20% pass-through deduction. But take a look over at the Facing Challenges column. Future graduate students now have a massive funding gap to figure out. Previous IDR borrowers might find that new 30-year forgiveness timeline pretty daunting compared to the older plans. And hey, notice that high-earning charitable donors are on this list too? Why is that? Well, it's because the new bill introduces a deduction floor. Basically, your first 0.5% of adjusted gross income in charitable giving is no longer deductible. To put that into perspective, if you earn $80,000 a year, the first $400 you donate just won't count for deductions anymore. Which brings us to our final part, Section 5, your tax action plan. Look, information without execution is literally just trivia, right? So here is your immediate step-by-step to-do list. Step 1. If you earn tips or overtime, you've got to update your W-4 with your employer immediately to reflect your lower tax liability. Get that cash in every single paycheck instead of waiting around for a tax refund. Step 2. If you've got student debt, go log into studentaid.gov. You need to figure out if switching to that new ramp plan makes sense for your income level. Step 3. Review your general 2026 tax withholdings so you aren't accidentally overpaying the government all year. Step 4. If grad school is on the horizon, start researching alternative financing and private loans right now to make up for those disappearing plus loans. And Step 5, sit down with a tax advisor to optimize your charitable giving strategy so you can navigate that new deduction floor. To make this totally foolproof, here is your complete timeline. This week, tackle that W-4. Seriously, don't wait. This month, get your student loans sorted out on studentaid.gov before those July 1st changes hit. This quarter, double-check that your overall withholding reflects the newly permanent tax brackets. Before the year ends, make sure you're maximizing tax-advantaged accounts like your Roth IRA and 401k. And finally, at tax time, triple-check that you are claiming the full child tax credit you're entitled to. If you follow this timeline, you'll make sure you squeeze every single ounce of value out of these new laws. So, I'll leave you at this. Which of these new tax rules is going to impact your wallet the most in 2026? Is it going to be that massive win on tax-free overtime, or maybe the new hurdles with student loan forgiveness? The rules of the wealth-building game literally just changed overnight. Make absolutely sure you aren't playing with an outdated playbook.